Hey everyone, welcome to my channel, Paid in Theta. And what that means is paid in time decay. So basically, I'm getting paid for time. Everyone says time is money, but it actually is in my case. So before I go on any further, I'm going to say this is for education purposes only. Do not try this at home, and this involves a lot of risk. I'm not a financial advisor, yada yada. So do not try this, but I'm going to explain how I personally make passive income weekly and how I reinvest it. So what this strategy is to make passive income is called the theta wheel. Like I said before, theta is time decay. So basically what I'm doing is a stock that I really, really want, even if it goes down, I am going to buy it, or I want to buy it. So for instance, AMD. I wanted to buy it at $50. It was above $50 because I want to buy it in the first place. And then if it does drop, then I buy it on the drop. And meanwhile, I get paid to do so. So in this case, everything is in 100. So I get paid 16 cents per share, and each contract is 100 shares. So this would equal $16. And in this case, I bought it back. So that basically ended before this expired. So I probably bought this back. I think I bought this the 21st. So it had, some more time left. That's why this still had value. So I wanted to buy it back just to close out, just to free up some money so I could do it again. But anyways, let me pull up a chart to kind of make this make more sense. So if you want to do this to Gilead, which is a pharmaceutical company, as everyone know, remdesivir with the whole coronavirus cure potentially. So what you could do is, it is trading right now at $76.75. So you could say, you know what, I would love to buy it right now, but guess what? It would even be better if I could buy it at $76, right? I mean, wouldn't it be better getting it for 75 cents off at that point? And you could get paid roughly. Now the numbers are skewed because usually you sell at the bid, but it's after hours, so all these numbers are skewed. But it would be close to this number, so about $180 because, like I said, this is per share, and each contract has 100 shares. So you times everything by 3, basically move the decimal point 2 over to the right. So the bid this you sell at the bid, so the bid is always lower than the ask. And because this is traded more frequently, it's going to be a little closer. So about just roughly $180 you'd walk away. So you'd make $180 today. You would have to put away $7,600 of your own money put away. You cannot touch it. That is basically put in the system so that if it goes below $76, you have to buy it at $76. So if it went to $73, you have to buy it at 76, and you would lose $300, right? Because that's the difference between 73 and 76 times 100. Negative $300. But you would have gained $180 initially. So really, well, yes, you still lose. You lose less. You would only be down $120 because of the difference. You got paid $180 up front. But if you get that money in it's just like a reinvestment circle. That's why it's called a theta wheel, the wheel strategy. If it's something you want to own for a long term, stocks go up and down, like you see here. It goes up, goes down. If it goes down and you have to buy it, and it's a stock you want, theoretically, stocks you want go up, not down. I mean, they can definitely go down, but stocks over time go up if it's a good company, if it's not a phony company. If it's a good company, and this is a well established blue chip pharmaceutical company, and if you sell premium, it can go up, it can go down, it can go sideways. You're still guaranteed that 180 bucks. So it would be the 5th, but whenever the next trading day occurs, which is the 8th through the 12th, which is 5 days, you can make $180. Think about that. That is really, really good money. That is really good money. It's a little bit over 2% return, but this is including the weekend, so it'll be a little bit less come Monday morning, but still, you get the point. You're making a good return on investment, and just think of it as insurance. You're selling insurance. So someone who has a lot of money, if they're like, wow, if this goes below, if they've got $1 million in their account, and they're like, wow, if this goes to 74, I'm gonna lose like, 10 grand, but I want to pay you $180, or maybe a little bit more, but just to keep the numbers easy, $180 so I don't lose 10 grand. Does that make sense? So they're basically hedging. It's like insurance, like car insurance. If you get in a wreck, the insurance company has to pay. But if you don't, guess where that money goes? It magically vanishes within thin air. No, it doesn't magically vanish within thin air. The insurance company gets that money and invests it to make more money. That's what I'm doing. I'm selling insurance on stocks. I'm a stock insurance guy. You could basically call it that. And that's basically guaranteed me getting paid, and it's locking me into a certain price. And if I want this company, like I have in the past, like as you can see here, you can see I wanted this company here for $74. I got paid $70 for it, so basically I got a free share out of it. I had to buy it. I bought it about 73, 77, so perfect. If you do the math, the difference between this and this, I make about $40 because it's actually, yeah, I make about $40 because it's just give or take about $30 there that I lose from it being under the 74, and then I gain 70, so that's $40 profit. So I make that $40, invest that money, and then what happened here was I sold it for higher call. I made $34 in less than a day because it dropped, and then I wanted to protect my downside even more, so I said the 74 call to basically break even. Guess what? I'm breaking even. I'm not making any money up or down. I'm making money on time. So I made another $68 that week. And this is the same week. So I make $100 in 1 week just by owning it. And yes, bear in mind, it is $7,400 I'm putting away to make $100 a week. And then the week before I made $70. So I make $170 in 2 weeks over, $7,400 in 2 weeks. So let's just do the math. So 7,400 plus your 170, 75.70. You divide that by your original investment of $7,400. That is a 2% return. A 2% return, and the stock went nowhere. The stock went to 74 1 week and went to 74 the next week. And I guaranteed myself 2%. So with that 2%, I'm now reinvesting that money and buying assets, in this case stocks, just like I'm selling stocks. I'm buying stocks too. So I'm buying stocks, and typically their prices go up, and I'm buying dividend stocks that pay me. So really I got paid that 170 is 2% on my money. That 2%, I'm investing that 2% into stocks, and those stocks are paying me anywhere from 2% a year to 7% a year in dividends. So really, it's just a continuous circle. That's why it's called a wheel. And theta means time. So I'm getting paid for time, which is pretty much the best intangible asset you can ever have in the stock market, because you can get paid for it to go up and sideways. And if it goes down, you get it at your certain price, and you could just resell it for a higher price or at the same price and make money over, you guessed it, time. So that kind of goes into the nitty gritty of time theta decay. So for Snapchat, just one more example for Snapchat, it is $20.33. 1 week today, it's the 5th, on the 12th, 7 days from now, you can make $51, the minimum. If you can get it anywhere in between, that's even better. If you can get the ass, that's great. $51 off of $2,000. That is a really, really good return. And Snapchat is above that price anyways. So really, it's like you're buying it on a steal. It's like you're buying it at a discount, and you're getting paid. So you're getting paid to buy it at a discount. And if it goes below, you're getting paid for your your money up front. So you're getting paid. I love doing the math of this because I just find it so fascinating. So 200, and there's 100 shares of contract, so 2,000 plus 50, your 51 that you would receive is that 20 or $2,051. So you divide that by your initial investment. That is a 2.5% return on investment per week. So every 5 days you're making 2% guaranteed. So what you could do, and this is what I do, what you could do is get this $51. If you think the stock is going to basically stay in the 20 area, or if anything, it's going to go up even higher. This is typically a bullish strategy. Even if it does go south, you're happy because you think the stock is going to do well. You make your $51. You use this money and you could buy at least 2 shares and have some money left over. So really, you're risking 100 shares to make 2 shares a week. And then you just keep doing that. So this money, this $50, could buy at least 2 shares of Snapchat. You buy those 2 shares of Snapchat. At the end of this week, if it's just above $20, that $50 turns to zero, just like this week. $0. Completely worthless. If someone sold it, guess what? Look, man, it expired. You can't get your money back. Oh, well, so be it. But guess what? You got your $50 and you bought the shares and you're owning it for the long haul. So this is just a strategy. Then again, this is not recommended for you to try it. It takes a lot of capital and a lot of risk, but if you have the money and the risk threshold, it could potentially be very lucrative for you. But this is not for everyone. And you don't have to look at stocks all the time to really understand and really be able to do this. And this is how you can make money week after week and can be consistently profitable and consistently bring in income so that you can reinvest and use for the long-term investing. So this concludes my video. If you like this, please consider giving it a thumbs up and leave something in the comment box. Tell your friends, because I think this is something that to me was a little bit unknown. I definitely didn't hear this as much a few years ago when I was really looking about investing. And yes, it is very cash intensive, so that does exclude a good bit of people. But if you can work your way to make this money will consistently generate you money, and you can use that money to buy more shares. And it's a snowball. It's compounding. I mean, it doesn't sound great. Oh, 1% a week, 2% a week on this, but that 2% invested, if an investment grows roughly 7%, I think it's the average over 50 years, 7%. So if that 2% a week, which turns out to be a lot over the course of a year, if that on top of your 7% a year, I mean, it's just exponential, and you get dividends and you get paid for, like, it's a big snowball at the end of it. So it's going to take time, but guess what? Time is on our side in this case, because if it goes nowhere, if this stock stays at $20 and nothing happens to it in a week, then all their money disappears and your liability is gone and you walk away with all the money. So I'm going to stop rambling. Very excited about this. I think this is a very good strategy. And if you're interested in this video, watch my other videos and see how I document this. I actually am on week 3 now. Pull it up. Week 3, I've made almost $800 and something, and with this money reinvested, I've made about a little over $900 in 3 weeks. So that's about $300 a week off of my money doing nothing. It's something worthwhile. If this video caught your attention, look at my videos, track my progress, and see for yourself how I'm actually doing this, and you'll get a good feel for it. So Paid and Theta signing off, and you guys have a good day.